All right, Peter. Here we go. Peter brought a lot of work, a lot of visuals today, so we'll get right into it. How are you, Peter? Hoping everything is smooth with technical things today. Let me see if
Absolutely.
I have. All right, there you are. Your mic is
hear
good.
Me well, right?
Your mic is good.
We can hear you. We just can't see your screen yet.
There we go. Okay.
Yeah. Perfect.
Welcome back.
Thank you so much, Dale. How are you doing?
I'm doing okay, buddy. Interesting times. You tweeted me that you have a lot of charts that you put together to kind of give us your view on the structure of what's going on here. So
sure.
If we could do this towards the end of it so people know how to find you. Why don't we just dive right into the markets? But everyone knows. Okay, Peter Ghostine, I've interviewed a few times. Peter's an excellent tactician, trader, analyst. We've made a few bets about the market, and he was right about a lot of things, especially the huge rally that we had in the market up until recently. So take it away, buddy.
Can you see my screen? The chart
that I have S&P's up here. Yeah.
So starting at the 2009 low, we had wave 1 into 2011, followed by the summer 2011 crash, which is merely wave 2. And from there on, we embarked on a multi-year rally. We had a little bit of a pause in 2015, 2016. And then we resumed the uptrend, and we had a rally just as
at B
equal in magnitude as the one from 2011 to 2015.
At B in 2016 was when you said you were backing up the Pinto and loading it up.
Exactly. So that is
okay.
And I use, of course, Copsy's approach to Elliott wave here, the harmonic Elliott wave model, where 1, 3, and 5 divides into or subdivide into ABCs, unlike the classic model.
Okay.
So right now, what we've done is we've reached the top of wave 3 or wave C of 3, and we're now in the process of tracing out wave 4 down to, I believe, it could be as low as 2264 to 2280. So something is going to happen, something unexpected that's going to scare the markets out of risk taking, and we'll see what that is.
You have any idea on time, Peter? Like we're 4?
Well, 2019 is going to be very rocky. 2019, nothing's going to happen during that year except choppiness and volatility.
Okay, so where are you from? Where you have 4? Is that in 2019 when 4 is complete?
Yes, but you have to give wave 4 the chance to, or the market to find its rhythm and base itself. It's not going to be a V recovery. Okay, it might be a triangle. It might be some sort of consolidation pattern. And, you know, just like in 2015, 2016, you had the first installment in summer 2015. We came back down and retested in February 2016, which was that zigzag here. B formed a zigzag. We came down, we hit that trend line, completed wave B of 3. While other indices, by the way, held their August 2015 lows. So nominally speaking, other indices did complete their corrections around August 2015, came down and retested in February 2016. So the same kind of story is going to happen. It's going to take some time. And then after that, you'll have wave 5, which I believe once things clear out, whatever those things are, we'll look back in retrospect and we'll see that this and that happened, and that's what the market was anticipating, and that's why people were taking off risk, or the big money was.
Okay.
So 5 will actually take us up from about 2,300 to 3,600. So we're going to have another phenomenal run, after which something is going to happen again to bring us back down to that area. Okay, but I'm not gonna.
Yeah, that's way out there.
That's way out there. Too much prognostication.
So yeah, the important things to get right is if we have a failing rally here, and then ride it, let the market wash out, and then have your shopping list ready of things that you think are going to lead. I actually think commodity stocks may lead in this next rally. What do you think?
I don't look at them much at all. I have not looked at commodities in years.
Yeah. Okay.
All right. I'm focused mainly on stocks, and in particular the semiconductors, which I believe are one of the engines of the new tech-driven modern economy. Now, if you look at the NASDAQ, same kind of chart, same exact formation. Blue 1, 2, we finished blue 3, and now we're in the process of tracing out wave 4. Okay, and that bearish crab target was my target since 2013. So we've had an incredible run. And I was pretty surprised when we exceeded it. But then when I looked at the pattern in mid-2018, I couldn't find a wave 4 or wave 5, red wave 5. So that's why I predicted that that's going to be another brief rally to set things up for the ultimate correction.
Okay.
Same thing with the Dow, same exact pattern. You'll notice when I bring up the Dow, exact same pattern. And the Russell, same exact thing. The subdivisions are unmistakable. Most importantly for me is the SOX. The SOX, if you know, or as you know, actually topped in March, okay? Yeah. And then after that, while the other indices were forging ahead, the SOX failed to make a new high. So that was one of the first ominous signals that, hey, if the semiconductors that were outperforming and leading the market are not, are lagging now, that was the same exact situation we had back in 2011 around February and March.
Yeah, I noticed that.
Right. So, and the other thing that I look at, other than the SOX itself, before I move along, notice the massive rounding bottom right here.
Yeah.
And this correction really is nothing but the handle that goes with the massive rounding bottom.
Okay, so you're looking for the handle to form on the cup.
Exactly. And you know what? This brings back memories of this. You had a rounding bottom in the NASDAQ composite, and the correction in 2015, 2016 was the handle. Okay, that's exactly what's going on right here, for me at least.
Only now, bigger handle, bigger move.
Bigger move, exactly.
And this handle comes back to check that breakout.
Exactly. Now
it all comes together, Peter.
For the
I feel like I know the jigsaw puzzle now.
That's how. Let me tell you, it's like the hand of God is moving the pieces on the board.
Yeah.
You know?
Yeah.
So if you look, here are the some of the signals that I've been monitoring almost on a daily basis. I monitor in particular a ratio that has served me really well. I came up with that in 2013, and that's the ratio of the semiconductors to the S&P 500. If you look at it here in 2011, when the ratio reached the 2007 high, we embarked on that correction, and the index kept falling. In other words, the SOX kept underperforming the S&P into early 2013. It based itself, formed a bottom, head and shoulders bottom, and then rallied again to that same exact level. And that happened in 2015, 2016. The ratio came back down to, you know, a support area, came back up in 2016 or so, finally broke through. And that's when I predicted that a major rally is going to develop, led by the semiconductors, which were finally outperforming and trying to catch up to the other indices. Now look what happened here in 2018. We registered the high in this ratio early 2018, came back down, bounced off support, came back up to see if we can exceed that high. We couldn't, and we left. And what we were left with is a topping formation. So as the semiconductors were basically the guiding light here, or the forward-looking indicator as to what to expect. Risk was coming out of the market in a stealthy way. And then the other thing that I look at is the breadth. I look at participation. And if you look at what happened in 2015, 2016, the market was, registering one high after another, at least the popular indices were. But look at the number of stocks making a new yearly high. They were pathetically low. So if you don't have participation, how can you sustain these high levels? That's when we crashed in summer 2015, came back down and tested in 2016.
Right.
The same exact thing happened right here. Look, yeah. we had that blow-off rally in January 2018, which blew my mind, the way the market moved in January compared to the decline in December. And ever since then, look at how participation kept dwindling down all the way to a point where the string finally snapped. The other measure.
Let me ask you a question, Peter. So, the averages have kind of masked all that weakness that you're showing in that last chart.
Right.
So is it possible that when we're near a bottom, that the shares, the internals, will get better when the averages are looking sicker to keep people away from the market?
Right. And if you think back at 2016, the S&P made a new low. The NASDAQ made a new low, but other less observed
like the NYSE,
even the semiconductors, the banking index, those guys came back down and didn't breach their August low. So they formed a divergence. Actually, you could also see the divergence in breadth, in various measures of breadth. Here, I like to look at participation by looking at the equal weighted versus the weighted S&P 500. If the high capitalization stocks are what are thrusting the weighted index up, you have to also take into consideration the equal weighted to see if the tide is lifting all boats. Is there enough participation from the other stocks other than the FANGs and all those guys and everybody? So here, in August 2012, by the way, remember when we bottomed in 2008, now we started having good participation all the way up to 2011. And then we came down, that was, into 2013 or 2012. That's when the index or the ratio bottomed. From 2012 to 2015, we had excellent participation. That's why we had what do we call that rally? BTFD, if you know what I mean.
Yeah.
And then we came back.
What's interesting is the November 08 low was so far above the 2000 low, it almost looks like, and that was a financial crisis.
Right.
Really, it didn't do that much damage to equal weight.
No, you're right. You're right. You're absolutely right. But then you might be comparing two different things here because they're so far apart. The stocks that were in the indices.
Oh yeah, they're always changing.
You're right. So
they got rid of the dogs and put in the ponies.
Right. Okay. Exactly.
I got it. Okay, good point. So
here's what's interesting here. You have that look of a head and shoulders because the market made a new high in 2016, 17, this is the entire 2016. Notice that the ratio didn't even, well, it came very close to its previous high here, but the indices were making new highs. Eventually, we had that topping formation. We broke below the neckline, and we're actually, this ratio right here is trading below its 2015, 2016 low right now.
So that's kind of bearish.
Yeah, it's bearish.
It's still bearish.
Yeah. Exactly. Okay. Now, the other thing of interest that I keep track of is, the bonds. I look at the bonds, and here's the picture, because bonds will tell you a lot about what to expect in the market. So February 2016, we bottomed, or you can go back to June 2014 when they topped, and then they gradually began to fall. Partial rally into March, May 2015. The indices were making a new high, and then they took a dump right here. They turned back down, and the market followed through. And then when we bottomed 2016, the market rallied as well.
Right.
They topped in 2017. This is 2018, the scare of, the scare that we had earlier in the year. Partial bounce. During that partial bounce, the market made a new high, or most indices did, just like they did in May 2015 or March 2015. And now we're about to break below the neckline at some point, okay?
So this is bearish bonds, at least near term.
Right. So if you look at the purple line here, the dotted line or the dashed line, I show a corrective ABC pattern. So eventually, for me to time the end of the correction, I want to see the bonds reach this level, or at least this particular ETF reach the 4370 level, below which everything was rejected earlier back in 2016. So you have that red line here.
You know, a lot of people don't follow this as much as maybe the 10-year yield. Would that take say take the 10-year yield maybe back to
same pattern, by the way.
250, something like that?
Right. So you'll see on whatever ETF you look at, 10-year, 5-year, whatever, they all sport the same pattern. I just happen to be using
this would take the 10-year yield higher, above the 3.25, right? So it could go to 4%.
Right.
If you're looking at that. Okay. Got it.
Last but not least, or actually a couple of more things I'll show you, is the banking index, which is very important. The banking index is a broad-based index, capitalization weighted.
Yeah.
Same exact pattern as I discussed earlier, wave 2, A, B, C into 3. 3 ended inside the crab PRZ. So eventually we're going to get to that level, 48.67, but not now. And notice how close we came in October to my target. You have a lot of support here near 33.30 to 32.36. So right now we're in bounce mode, okay? Right now the market is in bounce mode. I don't know if you saw my chart from yesterday, but what I expect in the S&P is a bounce which will be more or less touted as a Santa Claus rally, end of year rally, whatever. But look what's going to happen here. So we started to bounce. Right now, as we speak, we're around the 20-day moving average. But if you rely on the 50-day moving average as your trend indicator, we are trading well below it.
Yeah.
And
it'll come in up there around 2,800. I think it's 2820 now, or 40 or something like that.
2811 would be the S&P at that level, 2811. So I'm looking for 2811, 2812 for the right shoulder to form. And I'd like to give some historical perspective. The rally in May, June of 2011 did the same exact thing. Everything was celebrating it, but it was merely a right shoulder of a head and shoulders pattern back then.
So this rally could be 2 months and take us into December?
Right, it could take us into December. I think we have the low of the year or the low of this current correction already in place. Right now, what we're gonna do is we're gonna chop around while we're trudging higher towards the top of 4.
Take the VIX back down to 14, but it'll be still higher than the last level of 10, 12, something like that. Yeah, so build complacency into Christmas,
right,
and then pull the rug out going into, then the Fed pulls the rug out in December again.
You got that right. So that's exactly
we
what
got it all. We got it all cased. Do you have your lawn chair set up on that tropical island that you and I are going to have a margarita in January?
We should do that, right? We should definitely do that. We should definitely do that.
All right. Well, God, you know, I'm so glad you wanted to come back, Peter, after the technical glitches. And the best way for people to find you is, here's your website. Nice site. Let me just see. I think one of my alerts are going off. Okay.
I'm at Peter Ghostine on Twitter, 61.8 on the web. And by the way, I'm sorry about the technical snafu we had last time. It was really unnerving.
It was, you know what? It was meant to be now to prepare everyone for what's coming up, because a lot of people are going to get complacent. One of the guys I have respect for in Elliott work actually, I think, changed his mind looking for 3,200 in the S&P, but I don't know. He's not always right. I could see this being a failing rally too, and one more washout, because we never really reached the capitulation type stage on its decline. But I'll tell you what, I was in bearish ETFs at the top, and I want to tip my hat to anyone who was able to ride it for a month, because it was not easy to sit with a position with the way it traded down to here. Now, I think that this failing rally, if it pans out to be that way, will not be up 500, down 500.
No,
it'll be directional. And,
if I'm right, the next leg down will be a wealth maker. So you just have to sit it out, and not sit out the decline, but wait out this rally. And the way I'm trading it right now, is I sold premium below SPY 250, 245 put premium, or put spread. I sell that credit put spread, and I sold 285, 290 call spread. So I'm an iron condor, 245, 250, 285, 290. And you know what? That's into December. So I'm doing nothing during the day except looking at the charts and going about my life.
And collecting premium in the collar.
For the viewers, another way to time the bottom is via the SOX, the measured move of this triangle, which, by the way, is a Wyckoff top for Wyckoff practitioners. This is a typical Wyckoff top. The measured move is the low of wave 4 from back in, when was that?
Wave 4 of lesser degree.
I forgot. Yeah, this was 2018, earlier 2018, this low right here. So we ended up doing wave 5. No, actually, that was 2017, I believe. July, September 2017 is where wave 4 came. So can we go a little lower? Yes, but right now my timing will revolve around the 1028 to 1010 or something in that area right here, more or less, because I'll be selling premium below this purple area.
And well, you like playing the house in options, and that's the way to go. As long as you know how to get out of the way if one of your strikes is taken out.
Exactly.
It's like picking up nickels on the sidewalk till the steamroller comes.
Right.
I've seen that steamroller.
So, and look, there'll be times when once you time the market in terms of a significant move up or down, you can go directional with options. It's not always about selling premium, but the market trends up or down 5% of the time. So most people that buy puts and calls end up on the short end of the stick.
Right. Yeah.
That's why
Because of the decay. You have to get,
decay is vicious, man. Vicious.
Yeah.
So.
Well, you know, when in my cynical days, I used to say options are like relationships. 90% of them expire worthless. But I'll tell you what, I'm glad I maintained my relationship with you, Peter, in that 10%, because what a great presentation. And I know I could relax until December and get my you know, grub stake together and take advantage of this decline. So
that's right. Yeah. And by the way, Dale, you're doing a really great service. I keep my eye on what you're doing. It's pretty phenomenal. So hats off to what you're doing, my friend.
Well, thank you, my trading warrior brother. They'll think we have a bromance going here, and I love you.
Love you too.
So, all right. So have a great weekend, Peter. I hope pips rain down on you till we meet again, and keep in touch.
Thank you so much. Have a great weekend.
Okay, everyone, get Peter's letter and follow him on Twitter at Peter Ghostine. And F.A.C.E people, have a great weekend. You're welcome, Tom. You're welcome, Nick. And I'm looking forward to working with everyone again next week. Enjoy your weekend, but remember, don't just count your pips, count your blessings. Adios, warriors. See you Monday. Thanks again, Peter.
Thank you.